What's up everybody, my name is Jim, and welcome to my first video as Quarterly Deep Dive. I created this channel because I've been investing for a little bit now. I've found a lot of investor YouTubers that make really good content, such as Joseph Carlson, Everything Money, Meet Kevin, Unrivaled Investing, but not always about everything I'm interested in, or at a rate of content that allows me to stay up to date with everything that's going on. My goal with this channel isn't so much to really tell you what to invest in or what your strategy should be, but instead to really share coverage on earning insights as they come down and break down some companies that might not get as much attention or even any content at all on YouTube when major events for them happen in the general investing news mix. I might pivot towards making more diverse content down the road, but right now I'm just looking to have some fun and hopefully make something you all enjoy as well. So if you do, please like and subscribe. The topic I'll be talking about today is a Chinese company called Pinduoduo. Founded in 2015 by Colin Huang, Pinduoduo is an online marketplace that was created with the goal of connecting buyers and sellers of agricultural products, but has since expanded to many other types of products. The idea of a platform built around agriculture at its core might sound strange to an American or Western audience, but given that the Chinese agricultural sector is dominated by small, family-owned farms, who typically have to sell their goods to distributors at low costs, Pinduoduo has had success connecting consumers and producers directly while cutting out the middleman. To better show you the financial history of this company, I'll be using Webull, which is also a Chinese-owned company and a competitor to Robinhood. I myself don't use Webull to invest, but I do believe it to be a very, very good tool for doing research and monitoring the market. So, as you can see here, Pinduoduo is trading in a market cap just north of $72 billion. It has a forward PE of 30 times earnings, a price to book ratio of 6, and that's with $1.17 billion in cash on hand, no dividend, and 1.26 billion shares outstanding, which is a minor dilution from the original 1.08 billion outstanding back when they IPO'd in 2018. So one of the things that has made Pinduoduo really stand out and be an investor favorite has been its absolutely explosive sales and income growth over the past 5 years. As you can see here, Pinduoduo's revenue has grown from roughly 260 million back in 2017 to more than 6 times that in 2018 at 1.91 billion, over 4 billion in 2019, 9 billion in 2020, and nearly 15 billion in 2021. Obviously, as we all know, China is coming off the heels of a fairly stringent series of COVID lockdowns and some of the lowest economic growth that they've experienced since they opened to the West under Deng Xiaoping. So naturally, that should be a pretty serious concern for any current investor in China and might require a bit more of a magnifying glass than we normally use. Since this last result, Pinduoduo themselves did announce that the general malaise in China has been affecting their business, although to what degree and for how long remains pretty unclear. The last quarter, they slowed down just a tad from their past growth rates while still delivering admirable growth of 11.14% year over year with sales of 3.75 billion. It's also worth noting that they have quite the user base currently at 881.9 million active buyers in the last 12 months and 751.3 million monthly active users. So that's quite a huge user base, and the fact that it's still growing is pretty impressive. Last quarter, the number of active buyers for the trailing 12 months did increase by 7% year over year, and monthly active users grew by 4%. So they're still growing considerably, even though they're starting off a pretty large base. It's also worth noting that in order to increase their user base, they're allegedly planning to expand to the United States. Whether this actually shakes out to anything real or noteworthy is definitely something we'll have to see as it unfolds. But the story wouldn't be complete without that consideration that might be in the cards at some point. While revenue growth is definitely something investors like to see, ultimately the goal of every growth investor should be to see a company being able to turn revenue growth into bottom line income. And for that, we want to look at income, net margins, and most importantly, cash flow. Income to see how much more money the company has after everything is accounted for, net margins to see how profitable their revenue can be for the business, and cash flow to see how much usable money is actually coming into the business that they can use to grow, invest in research, pay down debt, or accomplish any number of other things to benefit shareholders. Their income last year was $1.22 billion, coming off of 4 prior years of losses, and last quarter they booked $410 million in income. So that's a good place to be, especially coming off of the year-over-year previous loss of $440 million. Net margin isn't on the screen here, but after being negative 30% in 2017, negative 77% in 2018, negative 23% in 2019, negative 12% in 2020, they achieved net margin of 8.27% in 2021. So this is also good. They're turning the money that they're bringing in as revenue into income more successfully over time. Not only are they clocking higher revenue, but they're making it be realized into something that they can actually use. And to see this going up over time implies that there might be more income that results from that revenue in the future. The net margin on the most recent quarter was 10.92%. Finally, we should look at their cash flow. Here our picture is just a tad bit murkier. As we can see, cash flow has grown from roughly 1.13 billion in 2018 to 2.13 billion in 2019 to 4.32 billion in 2020 and then 4.53 billion in 2021. So this is pretty good. It's growing. The amount of money that they're bringing into the business from their operations is increasing over time. It's worth noting, though, that last quarter they started off the year with 1.43 billion in the red. Last year they also did that. The first quarter has typically been a time where they've been a little bit cash flow negative, but at that time it was to the tune of a much lower $570 million in the red. So while they're growing pretty consistently in the area of sales, this isn't exactly one-to-one with the money that's actually coming into the business. Okay, so now that we have a pretty good idea of what Pinduoduo has been historically, a very high-growth Chinese tech company that hasn't always been completely consistent, but has been generally growing on the top and bottom lines for most of its existence, let's take a look at what's expected in the earnings. The current consensus is earnings per share of 38 cents, a decline of 13.6% from the year ago aggregate number of 370 million in income, and revenue of 3.54 billion, or a decline of 0.8% from the previous year's number. So Wall Street is definitely expecting the lockdowns and the recent economic difficulties China has been experiencing to take a bite. Given that the stock is off a 52-week high of $109.79 and a low of $23.21, I think it's fair to say that there's a lot of uncertainty with China right now, and that there's likely large potential for an upside or downside surprise. While I personally don't own any Pinduoduo or any Chinese stocks, I do think that the bull case is worth paying attention to, and as we learn more about what has been unfolding in the Chinese economy, this company will prove to be one of the more important stories going forward. So that's Pinduoduo. My name's Jim, and I hope you liked this video. If you have, please like and subscribe, and I'll try to make another one of these for you all soon. Thanks. Bye.